presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compact Market Wrap YouTube update for August 25th, 2025. I'm Mo Ansari, President of Compact Asset Management, and thank you for joining me today. First of all, don't forget to subscribe to this channel. Just click on the subscribe button, so whenever I post an update, you'll be notified and you can watch it at your convenience. Today I'm going to talk about the charts in a little bit more detail, so that will be at the end of this presentation. Also, if you'd like to get information, what we do, how we do it, if you want help on your portfolio, send us an email at invest@compact.com or simply give us a call at 800-388-9700. Looking at the numbers last week, not a big week, even though we had a big Friday with the Jackson Hole speech from Chairman Jerome Powell, who said, yeah, there's a chance that we should start bringing interest rates down. That sort of confirmed the high probability that everybody is looking at, that in September we are going to get an interest rate reduction. How much it will be, I believe it's 25 basis points or 1/4%. That is what is expected, depending on how the unemployment numbers also come out at the beginning of next week, next Friday, not this Friday, but the Friday after that. We'll get the unemployment data, which will show us how the August unemployment is and if the economy is really slowing. Dow was up 1.59%, but the NASDAQ not doing as good, down 0.55. So we saw the Dow was number one, S&P number two, and then we saw the NASDAQ as number three. And small caps had a big week up 3.32%. They are the biggest beneficiaries. When interest rates come down, small companies, their chances of making profits go up because big companies can issue bonds, and they have done so already. So they are not as dependent on interest or getting loans from banks. But small businesses are, and lower interest rates help small businesses. That's why we saw a big jump up with the expectation of lower interest rates next month. Energy was the best sector last week, and the worst sector for a change, technology, down 1.6%. So has the technology run out of steam? I think it's just a matter of consolidation. That's what we're seeing. And the broader market is going up. If you look at the second best sector, it is industrials this year. It is up 17%. It is up. Technology is only up 14%. So we are seeing industrials do better than technology. That means the economy is broadening, or the market is broadening out, and people are starting to buy industrials, and that is pushing their prices up. Oil was down last week. Interest rates literally unchanged, 4.33 to 4.26. Not a lot of change, slightly lower, but we saw bonds go up more than high yield, which is not a good sign. I like to see high yield going up more, so we'll keep an eye on that, and that usually tells us the strength of the economy is how high yield bonds are doing. We're seeing a lot of companies start to come to market now. We saw a lot of them come in 2021 right after COVID, because there was nothing literally in 2019 and 20. So a lot of companies, but now we're starting to see, this is the public listings are up 27%, and then the merger and acquisitions where other companies are buying companies up 73%. So that is a big jump that we're seeing, a lot more companies cashing out. And that's a good sign, usually a healthy sign for the market overall. Last week we saw the composite PMI come out, 5.4. We saw housing rates rise to, housing starts up to 1.321. Not a big news. Same thing this week, not a lot, but the big number is going to be this GDP number for the second quarter. Expected to be the same as it was last quarter, 3%, 3.1%. We'll see how this GDP comes out and how it comes out on, I believe, on Thursday. So that's going to be the big news for the week. Rest of it, not a lot of data. Looking at the markets, and I've talked about this was the target, 63.50 to 64.50. That's what the target was, and we were right there. Today we closed it, as a matter of fact, 64.50. That's where we are at. We went up again on Friday, but did not make a new all-time high. But we've seen the market sort of stay right here and start to fall off. Support 63.92, which is the 20-day moving average. Then we have more support right here, which is 62.78. A couple of 100 points lower. That's on the daily charts. On the weekly charts, one thing that we've seen, the market has made highs right here. This was an all-time high. This was a new all-time high, and then we're pushing this. But if you look at the RSI, this is a technical indicator. Usually the market, it follows the market. But here it made a new high, or it went to a high right here, and the market was at a high. But here the market has gone up more. You look at this, these are higher highs, but you look at the RSI, it is making what is called lower. This is lower, while the market is higher. Usually these should follow. They should go up with the market. If the market's new all-time high, they should go to new all-time highs. But that is what is called a divergence in the market, where the market goes to a new high, but technicals do not, and that is usually not a good sign. So support around 62.5 on the dailies, 6,000 on the weeklies is what we're looking at, 6,058, maybe 6,100. We're at 64.50 today going into the close in the markets right around there. So, I think markets are fully priced. We got good news in the market. Market didn't go, it went up on Friday, but not to new all-time highs. You've heard me say over the last 30 years, when the market you get good news and the market does not go up, watch out for that. Or when you get bad news and the market does not go down, that's usually a sign, time to look to buy the market. I think the market just fully priced right here. Well, I've said that for the last 3-4 weeks, 5 weeks, but again, market hasn't gone anywhere in the last 4 or 5 weeks. So we're still sitting right around there. Time to check your portfolio. Make sure that if you do hit an air pocket, that you do have your seatbelt on. That's really what it is. It's not, the plane's not crashing, but it could hit some turbulence. And if that happens, best thing to do is have your seatbelt on. Same thing with your portfolio. If you do see some volatilities, some pullback in the market, make sure you have the right allocation. That's really NASDAQ, same thing, support around 21.2 and then 20,700. Today we closed at 21,500. So that's on the dailies. The weekly support is around 20,000 and then around 19,000. So those are numbers we're watching. If we do start a pullback, we're at 21.5. So a 1,500 point pullback, 1,000 point pullback would not surprise me at all in the NASDAQ, or maybe even a little bit more. Interest rates still stuck in this range, right around here to right about here is where we are, just going up and down, up and down, up and down. Really stable, which is good. But if we break out to the upside, that would not be good. That would indicate inflation is coming. Break out to the downside. Interest rates go down too much. That means that the economy is slowing and the Fed has got to lower interest rates to support the economy. Not good news for the economy overall. Gold chart stuck again in a range, made this high, fifth wave high. I think again, anxiety has died down in the market, really going sideways for the last week and a half. Oil back up a little bit today as the prospects of a meeting between Putin and Zelensky comes down a little bit. And with that, the fear that was that there could be peace in Ukraine, which could bring a lot more oil to the market. And that's why we saw the oil prices drop off from 70 down to about 62. And we're about 65 today. That's where we are, not a lot. Bitcoin, again, it gapped up here, and I thought this was an exhaustion gap. We're below the 20-day, below the 50-day. And I wouldn't be surprised to see a test of these lows right here, which is around 58. That's the number that I'm looking at. And by that time, we could see the 200-day moving average also come up. High yield bonds, again, just like the bond market, stuck in a very tight range, nothing going on there. Those are my thoughts. Those are my observations. We'll be back next Tuesday because Monday is a long weekend. It's Labor Day, so enjoy your long weekend. We will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.